We are joined this morning by Chicago Fed President Austan Goolsbee. Austan, good morning. Such is the world we live in that what I thought was the news I was going to ask you about has changed in the last hour to be different news I'm going to ask you about. And I want to start directly with two tariff announcements from the president, one that appears to be directed at Apple, another 50% tariffs on the EU. And I'm just wondering how you as a policymaker react to this kind of changing environment when it comes to big economic declarations from the White House.
Well, we had the big Fed Listens event last week at the Chicago Fed, and a whole bunch of folks from the district came in to talk about the economy. And the two common themes were, number one, they hate inflation, and number two, they want some consistency. The CEO of a construction company said for them, we're now in a put your pencils down moment where they just have to wait if every week or every month or every day there's going to be a new major announcement. They just can't take action until some of those things are resolved. So it's not surprising that's the environment that we have been in. But it does just heighten the amount of, it's more than uncertainty, it's the non-consistency that for bigger decisions, the businesses are saying that they need to have some idea that it's going to be a constant that they can count on when making the investments.
So the uncertainty is one thing. What about what's being discussed? For example, a 50% tariff on imports from the European Union. Is that a big enough thing to be a macro factor to affect policy?
That sounds like, I mean, to go to 10% was going to be the highest tariff rate that we had on the world in 90 years. To go to 50% is a completely different order of magnitude. Now, at the Fed Listens event, and when I'm out in the district, here, the Chicago district covering the Midwest is the most export and import trade tariff exposed district of all, including 4 of the top 7 highest exposure states. As they look at tariff rates that are that high, that would be really scary for the supply chain. But there was at this event an expression that maybe this is just a stepping stone, and that on the back end of this thing, we could get some new deals, we could open up some new markets. Maybe this won't happen. But if every few weeks we're going to get new and larger tariffs, there was a lot of anxiety that it's going to disrupt the supply chain and kind of take us back to an environment of rising costs like the ones we experienced in 21, 22, or even with the supply disruptions of 2020.
So not to be too reductive about it, Austan, but what does it mean for policy for you when it comes to, am I willing to cut? Am I willing to hike? Do I need to stay the same? How do you put all of this into the hopper and come up with essentially what is a binary decision for you?
If they did it's sort of 2 parts. In the short run, we got to just wait for the dust to come out of the air. If you throw a lot of dust in the air, everything's always on the table, but I feel like the bar for me is a little higher for action in any direction while we're waiting to get some clarity. And then over the longer run, if they're putting in place tariffs that have a stagflationary impact, which is to say they slow down output by raising the cost of production while also raising prices, then that's the central bank's worst situation. That is a stagflationary where both sides of the legal mandate get worse at the same time. So I think we'll have to see how big the impacts on prices are. I know people hate inflation, and they've expressed that many times.
Yeah, Austan, a put your pencil down moment, the latest put your pencil down moment. I would think that the pencils might have already been down from what has happened since April 2nd, whenever it was. And my question was, I don't know whether we've seen the negative effects front and center from what you would have expected at that point. And I'm wondering.
I think that's an interesting observation, and it kind of goes to I've said on this program before, Remember, imported goods are only 11% of GDP in the United States. So there is a sense in which if we don't go wild, if it doesn't jump out of its 11% lane, it could be like 2018 where we had tariffs. They impacted the directly affected industries, but they didn't have a big macro effect.
I just wonder, is it still coming, or could this cause it? Where is it? Is it still coming? Are we vulnerable to more shock that would definitely put us there, or is it it's going to keep the economy just keep on going?
Yeah, well, I hope it just keeps on going, and that we come back in a few months and say, hey, it was only stayed in its 11% lane. It didn't have that big of an impact. My only fear here, I shouldn't say my only fear. A fear here is, remember, the data come out with a lag. The price data come out with a 1 month lag. The GDP data come out with a 1 quarter lag. And so something might have already happened. And it's like watching last night's game on replay the next day. If you already know the outcome, you're not feeling that great about it as it's going along. So if we get multiple months like the last month where inflation is not accelerating, then I would definitely feel a lot better about it.
Hey, Austan, all of this news happening this morning, so we've completely changed the focus of what we would have been asking you about. Yields are down slightly this morning, but those higher yields that we've been watching all week, I just wonder how big of a concern that is for you, how big of a concern it is for the business leaders that you've talked to along these lines. If rates are going higher, regardless of what the Fed decides to do or not do, what you think about losing control of the long end of the curve, and what you think about what that means for the economy.
Yeah, each of those is critically important. Now, the market determines the long rate conditions, as you say. The Fed, we're setting the Fed funds rate. We're looking at the short end. The long end are the conditions in the economy, and those can be causes or those can be symptoms. To the extent that the conditions are getting tighter on the long end, that does affect investment decisions, consumer durable purchases pretty directly. So I would think, want to factor that in is there going to be slowdown? At the same time, if we're going to get a big fiscal stimulus that's pushing back the other way in the short run, we have to weigh off considerations like that, too.
That's what I meant, Austan, when I started off about what news I was going to ask you about, because
yes.
I was going to ask you about the fiscal side. What is your take, though? And I think it's in a couple dimensions here. The first is you just responded to, which is the fiscal impulse, the stimulus that might be coming from this bill. The other, though, looks to be a financial stability question about the ability of the U.S. to finance this. How do you approach both of those questions?
Yeah, look, those are both important. Once you become a sworn member of the Fed, you're out of the fiscal policy business. So I'm not expressing Congress and the president that can pass whatever tax policies, spending policies, fiscal side that they want. Our job is to look at anything that affects prices or employment. The law tells us that's our dual mandate. On financial stability, I do think that there's so far been a bit overblown in the discussions of whether the market accepts it. These are historically pretty normal interest rates. You would think that if there was truly a crisis of confidence in the U.S. as fiscal agent, that the rates would be well higher than where they are now. The fact that they're moving in a direction, it's best to take a long view. They're going up, but we've seen a lot of movement both up and down over the last year and a half. So I don't think we should overreact to that. The fiscal impulse, what does it mean for GDP growth? That's going to be determined by, well, how big is it and what's going to be in the bill? And so we're not political prognosticators either at the Fed, so I don't know exactly what's going to happen.
Andy, let me just follow up on that real quick. So, Austan, we have this same question, and you've been given the same answer for like 6 months now. you had.
Was it the right answer? It probably was the right answer.
Well, it's far enough in the future that you have a lot of fudge factor in there. In that, there were two cuts that were put together by the committee, the average of the committee, the median of the committee, when it comes to rate cuts this year. Where do you stand on that? And how does all of this stuff we talked about, changing fiscal policy, changing tariffs, the uncertainty of whether or not the tariffs are showing up in the data, where does all that put you on your outlook for rates?
I say. Now, you know I don't like even mildly tying our hands at the next meeting, much less over 6, 8, 10 meetings from now. That said, as we went into April 2nd, I believed that we're at pretty stable full employment, that inflation was on path back to 2%. And if we could do those, I thought that over the next 12 to 18 months, rates could come down toward a fair amount, toward where the let's call it the dot plot was saying rates would settle, which was a fair bit below where rates are right now. I probably got to modify, so now it's 10 to 16 months from now. Right. But I still feel like if we can clear the dust out of there, that the underneath, the economy still has that strength that it had going into April 2nd. And if Joe's scenario played out, that it wasn't, that the tariffs and the uncertainty were not a threat to increase inflation, I'm still underneath hopeful that we can get back to that environment. And 10 to 16 months from now, rates could be a fair bit below where they are today.
I'm glad you modified that, Austan, because I'm going to have to modify it for you if you didn't go down from 12 to 18.
Right.
Hey, Austan, I know you talked about sort of political prognosticating, but let me ask you, this is a political question, but it relates directly to what you do and who you are, which is that the Supreme Court yesterday appeared to insulate you and your brethren, if you will, from being able to be fired by this administration and in any administration. The Supreme Court effectively saying that board members would have a greater protection against being fired by the president than members of agency leaders, in which case Trump has done that to other agencies. What was your reaction? Was there any conversation inside the Fed about that yesterday?
Look, I'm not a legal scholar, and we, the Chicago Fed, we weren't party to this lawsuit. You know my views. They are unanimous, pretty close among economists, that Fed independence and central bank independence from political interference is critically important if you want to prevent inflation from coming back. So other than just being gratified that it looked like the Supreme Court acknowledged the importance of Fed independence, I don't have much.
I got a real different question, though. If, in fact, Jay Powell would be replaced, I mean, that's just the truth, but next year, how much do you think that will change the way you and your colleagues do their jobs?
I don't know. Jay Powell's the only chair that I've served under. If you look through the list of Fed chairs, it's a pretty distinguished list. So if they pick somebody who's smart and who embraces, the Fed's dual mandate, I don't think it would change the way we do business that much. But it's pure speculation.
Austan, I was going to say, you're going to fire me? Yeah, make my day. I mean, it's a hard job you have. I'm not sure, it's like, I don't know. Is that a relief you can't be fired, or is it? But then I was thinking. Yeah,
I don't know. Condolences. Joe, exactly. I thought you were going to celebrate in the vanquishing of your enemies. They're ending the penny, and we're not going to have the penny anymore.
I don't like those pennies. It costs more to make. I do pick them up if they're heads. No, what I was then going to say is you've been very good for the Fed, I think. But even more so, the Fed has been really good for you in terms of, we used to make bets.
It's like
we used to say these terrible fiscal policies, you'll never get to 3%. I can't win my tacos back now because you can't make a bet on what fiscal policies are good.
I'm not allowed
or which
to
ones.
bet, and I'm not allowed to take free gifts, but you still owe me. You know in your heart you still owe me dinner.
But you no longer are pushing those horrible lefty politics. I mean, you're a changed man now.
I joined the Night's Watch, and I'm out of the fiscal policy business.
Wow, the Night's that from Game of Thrones.
Game of Thrones.
That's right. That's right. I thought that was nice, though, that you've been really good for the Fed, but it's been good for you, too, I think. Is that a compliment?
I appreciate the thought, Joe. Yeah, I'm going to take it as one, even if it wasn't
Yeah,
intended.
take it and go, Austin. Don't go any further than that because
I will
you'll
call
find
you
out what he
President
really means.
Goolsbee.
Yeah,
And
I call
thank
you President.
here.
I call you President.
Goolsbee, thank you very much. Steve,
Pleasure.
thank you
Thank
very
you.
much. We truly appreciate it.